In this chapter, we'll be discussing about bond yield. That's an important concept, but at the same time, can be a bit difficult for beginners to understand. So if you don't totally understand, it's okay. Even if you understand, say 50% of it, it's more than enough. Okay, it's a bit advanced topic. Usually, these questions are asked in an interview if you are from a finance background like MBA or commerce. Okay, if you're a fresher from non-finance background, they usually won't ask that, but it's something that appears a lot in banking and financial news. So it's better to be aware of at least the basic concept of yield. Okay, what do you mean by bond yield? So an investor who purchases a bond will get return from two ways. One is the coupon interest payments, another is the capital gain or capital loss when the bond is sold, isn't it? So say for example you have bought 100 rupees a bond that matures in 5 years. So what is your interest in this? So during this 5 years period, every quarter or every half year you'll get interest. So that is one income for you. Other is in between this 5 years period, say the bond price has increased from 100 to 120 in the market, you can sell it and get 120. So that is a profit. So there are two ways in which you can benefit from the bond. Yield of a bond is a measure of the return the bond holder gets. Okay, so it is the return the investor gets on the bond. Now this return will be the sum of all the money that is earned, that is interest plus the principal repayment on maturity. So as we discussed earlier, bondholder need not wait till maturity. It can sell the bond before that date. Okay, so the money he gets by selling the bond is also part of the yield. So one important relation you have to understand is as bond prices increase, bond yield falls. Okay, so say for example a bond is issued at 1000 rupees with coupon of 10%. So every year say you're getting an interest of 100 rupees. So what do you mean by annual yield? Annual yield is interest divided by at par value, that is in this case 100 by 1000, that is 10%. Let us suppose you sold the bond to me at 900 rupees. Now here is an important point. Even though you sold the bond to me at 900, I will keep getting the interest of 100 rupees still. Okay, because who pays the interest is the company. It's immaterial to the company who the bond is with, is whether it's you or I am holding the bond. It's not important to the company. The company will keep paying on 100 rupees coupon on the face value of 1000, 10%. So 100, whether to you if you are the owner or whether you have transferred the bond to me, I will get the 100 rupees. That won't change. Okay, but now, okay, if you think about it carefully, I am gaining because my yield or my return is 100 by 900. 100 is the interest, that is not changed, but the price at which I purchased is 900, not 1000. For you it was 1000. So when you calculated your yield, you got 100 by 1000, that is 10%. But for me, I bought it at 900, so I paid only 900 to you. So it will be 100 by 900. So my yield is 11.1%. Then if I sell the bond at a lower price, yield will again increase. Okay, and if I sell at a higher price, yield will fall. So as bond prices increase, bond yield will fall. Okay, that's a very important point you have to remember. So when do bond yields fall? Let us see. So you have to think of bond as just another investment option. Say you have a lot of money, you want to invest in, you have more money than what you need. So what you do some investment. You invest in real estate or share market, gold. The varieties of ways in which you can invest your amount. One option is bonds. So you have to think of bonds as an investment alternative. When will people invest in bonds? If they find it to be attractive than other investment options. If the other investment options are paying more, naturally you will not be interested to invest in bonds. Whereas if the bonds are giving you more return than the other options, naturally you'll be inclined to invest more in bonds. So that is the point. So when do bond yields fall? If somebody asks you in an interview, if an investor finds some other investment option more attractive, he will invest there. So bond yields will fall when the current economic environment is such that there are safer investments or other investments which are offering more return. Usually this happens during times of slow economic growth, increasing interest rates. Okay, and that's a very important point, the link between the bond price and the interest rate environment. When we say interest rate environment, we mean the general interest rate environment in the country. Sometimes you can say the prevailing interest rate is around 7%, 8%, 9%, 10%. We speak of one single figure. This is not a particular rate offered by any bank. You can think of it as a Well, we'll see what are these different rates which can capture this single number. Okay, it could be the bank rate that is determined by the RBI. It could be any other rate, but there will be periods in which the interest rate, the general trend of interest rates will be rising over a period of time, and there will be periods when the interest rates will be coming down over a period of time. Okay, then in that case, the link between bond price and interest rate environment is such that when interest rates are increasing, bond yields will fall. Because say for example the interest rates are increasing, it means, say for example, a bank which earlier used to offer 7% on a fixed deposit of 1 year is now offering 8%, say. Okay, a fixed deposit for 1 year, which earlier was the bank was giving only 7%, is now they're giving 8% because the interest rate in general is increasing throughout the economy, and the bank has increased the rate of interest. Now as a bond holder, if you feel, and say for example your coupon interest rate is 7%, earlier your bond was giving 7% and the bank fixed deposit also giving 7%, so you're indifferent, it doesn't matter, so you stayed with the bond. Now the bank is giving you 8%, so now there are other options which are more attractive. So what you do, are now people willing to buy bond? If you want to sell, say for example the face value is 100, are people willing to buy from you? No. In this case the bond will fall, the yield will fall. Okay, so the link between bond price and interest rate environment is very important, and let us take in detail an example. Say a bond is issued from 1000 rupees with coupon of 10%, so every year you will get interest of 100, and if the prevailing interest rate is also 10%, you will not feel the need to buy the bond because the bond is also offering 10%. It's nothing more than anything available outside. But now if the interest rate in the economy falls to 8%, what does it mean? It means, we discussed earlier that the coupon, the company will still be paying 10%. So now the bond is more attractive because other options will be paying only 8%, but you will be getting 10%. On the other hand, if interest rates rise to 12%, the bond is now less attractive because it's still paying only 10%. Okay, whereas outside you're able to get 12%. So bond price will decrease. So to remember that the bond price move inversely to interest rates. Okay, bond prices and yields move in opposite direction. So when bond yields go up, prices go down, and when bond yields go down, prices go up. In other words, say a treasury yield move in 10-year treasury yield from 1.8 to 2.3% indicates negative market conditions. This is one of the bonds. Okay, 10-year treasury yield. We'll see all of these types of treasury bills later. So if you see in the papers, like there is a move in the 10-year treasury yield from 1.8 to 2.3%, don't think it's a positive thing. It indicates a negative market condition. Whereas a move from 2.3 to 2.1% is a positive market condition. So this is an inverse relationship. So don't get confused. Okay. So bond prices and yield move in opposite directions. So bonds that have already been issued are trading in the secondary market will continually readjust their prices and yields to stay in line with current interest rates. Okay. So as I told earlier, it might be a bit confusing topic for you, but at least try to understand what is the basic definition of yield. Okay. So there are three common measures of yield. One is coupon yield, is the current yield, and another is YTM, that is yield till maturity. So coupon yield is the coupon payment as a percentage of face value. So this is the interest the government or the company that has issued the bond will pay at regular intervals. So say 100 rupees is the face value, coupon rate is mentioned at 10%, so 10% is the coupon yield. It doesn't reflect the impact of interest rate movement and inflation on the return you get. Okay, so just the simple formula is coupon payment by face value. Okay, so say for example there is a coupon rate of 8.57%, face value is 100, current market price may be 105, but the coupon yield is still 8.57 by 100, that is 8.57%. So it has got nothing to do with the current market rate. Okay, coupon yield is also called nominal yield. Then there is another measure of yield known as current yield. So the bond holder may have purchased the bond and after issue at higher or lower price. As a percentage of the purchase price, when you calculate the coupon, it's known as current yield. So current yield is coupon rate by purchase price. So same in the above example, 8.5% is the 57% is the coupon rate, face value is 100, but market price is 105. In this case, the current yield you will calculate as 8.57 divided by 105. Earlier you calculate only 8.57 by 100, that is coupon yield. But for current yield, you calculate as a percentage of current market price. So 8.57 by 105, that is 8.16%. Okay. So it takes into account the current market price. but it doesn't take into account the reinvestment of the interest received periodically. Then there is one more measure of yield, the most popular measure, that is YTM, that is yield to maturity. This is the annualized return an investor would get by holding the bond till maturity. Okay, so this is the combination of return of all payouts and coupon, and is the best measure of return rate of a bond. Okay, so this is the expected rate of return on a bond if it is held till maturity. Here we are assuming if this bond is held till maturity, what is the return we get. Okay, we had a discussion of a discounting when I discussed about DCF, discounted cash flow analysis, in earlier chapter, so please refresh your discussion there. So the price of a bond, what is the price of a bond? It is the sum of the present value of all cash flows. To understand this statement, you have to refer back to the chapter we had under discounted cash flow analysis. Discounted cash flow means the future cash flows, we apply a discounting rate to bring it back to the present value. Okay, so price of a bond today is nothing but the sum of the present values of the cash flow. Say for example, 100 rupees is the face value you have purchased at the face value 100, and the coupon is 10%. So for the next 5 years you'll get 10, 10, 10, 10, 10, and at the end the maturity you get back the 100. So what is the amount you received in total? 5 into 10, 50 plus 100, 150. You may think you got 150, but that is wrong. As per DCF analysis, you have to discount the future cash flows to the present value, because 1 rupee which you earn today is more valuable than what you receive tomorrow. 5 years from now, say you receive 1 lakh, that is less in value because prices will go up. Okay, so that may be much less valuable compared to 1 lakh which you receive today. So whenever you speak of future cash flows, you have to sort of discount them. Okay, you're getting the point? If you speak to your parents or an earlier generation, like grandparents, the salary used to be just in hundreds, 600, 1000, whereas now it is 50,000. So how are they able to sustain with that? Because the prices were less. Okay, similarly, if you go into future, maybe 10 years from now, your children will be having a salary of 10 lakhs per month maybe. That doesn't mean it is more. We are comparing 10 years from now. At that time the cost will also be more. So 10 lakhs at that time is less valuable. Today it is more valuable. Okay, so you cannot compare today I'm just having a salary of say 50,000. 10 years from now my son is earning 10 lakhs per month. You can't compare these two because the time period is different. If you want to compare them, you have to bring them back to a common level, and that is done by discounting. You apply a discounting factor to the 10 lakhs to bring it back to the present value. All this we discussed in the chapter of discounted cash flow analysis. So the price of the bond is also calculated like that. In the real example, the 100 rupees bond, you get 10 rupees for the next 5 years, 10 plus 10 plus 10 plus 10 plus 10, and you get back your 100 the 5th year. But that doesn't mean you get back 150. You can't just add 10 into 5 plus 100, 150. You're not getting 150. You are getting 150 in future at different time periods. What is the value of that 150 today? Its value will be less. That is the concept of present value. What you receive tomorrow will be worth less, okay, than if you receive today. So let us speak of the first 10 rupees which you earn after 1 year. Maybe it's worth today, just if you do discounting roughly, let us say it's say 9 rupees. The 10 rupees which you receive after 2 years is worth even more less. It is just 8 rupees as of worth today. The 10 rupees which you receive after 3 years may be just 7 rupees. So what you're actually receiving is not 10 plus 10 plus 10 plus 10 plus 10. You're receiving only 9 plus 8 plus 7 like that. Okay, and the 100 which you receive after the redemption, right, after 5 years, maybe worth is just maybe 70 rupees. Okay, so if you add up all that, you're getting not just 150, it's less than 150. Okay, so that is the concept of discounted cash flow analysis. So that's how we calculate price of bond. Price of bond is the sum of the present value for all cash flows you're going to receive in future. So you discount each cash flow at a rate which is YTM. Okay, there comes the link with YTM. In other words, YTM is the discounting rate at which the present value of the future cash flows equals current market price. This is a complicated example. The concept is difficult. Usually you do this for MBA students. If you're a fresher, don't worry too much about calculation of YTM. It's not required. Okay, in fact there are softwares to do that. Just understand the basic concept of yield, the measures. So in this chapter, the questions will be prepared. What is yield of a bond? What happens to a bond yield as bond prices increase and why? When do bond yields fall? What is the link between bond price and interest rate environment prevailing in the country? We discussed this. Does a move in the 10-year treasury yield from 1.8 to 2.3% indicate positive or negative market condition? It indicates a negative market condition. What are the three common measures of yield? We discussed coupon yield, current yield, and YTM. Is coupon yield related to market price of the bond? No, it's not related. So what is current yield? What is YTM? Among the three yield measures, which is the best measure? That is the YTM. Okay.